talk about all these different things, and people ask me about forecasting. The reason I put this up is I want to share my view of how all of these things fit together and what it means for Ferris. And we've heard already some pretty dismal things, so allow me to pile on and begin with a quote. We're not technically in a crisis. This was the response of an IMF, one of the heads of research at the IMF last month in their press conference when they released revised growth forecasts lower for most economies in the world. And in the press conference, somebody said, well, are we in a crisis right now? And this was the response. Well, we're not technically in a crisis. This was followed up by the equally inspiring statement, we're on alert for a crisis. That's where we are right now in the global economy. If we want to see where growth is, and I know these are smaller charts, so I'll read off some of the big numbers that matter. You can see all the numbers in red under 2016 and 17. Those are the numbers that the IMF lowered last month. And by the way, these lowered numbers came a week after Christine Lagarde, the head of the IMF, did a TV interview with Bloomberg Television. And Francine Lacqua asked her in a series of interviews, in a 3.5-minute interview, came after Lagarde had given a speech in Frankfurt, different questions about the economy. And it was before these forecasts were released. And Lagarde was asked explicitly, are you worried about risk of recession? Not once, but twice. Now, if you're the head of the IMF and someone asks you, you're worried about risk of recession, there's really one right answer. And the answer is, no, not at all, not at all. Nothing to see here, just keep moving, right? But that's not what happened. The question was deflected twice, and instead, Lagarde highlighted 3 big concerns that she was looking at. And the first is the transition of the Chinese economy, which the Chinese GDP forecast, though, for this year was raised to 6.5, but that's number 1. Number 2, low commodity prices, and specifically low oil prices. And number 3, the risk of contagion for financials. And she didn't use that word contagion, but she said the risk to financial services sector. Those are the big 3. And those are 3 things that I've been concerned about for a while. I know Autumn mentioned my book, Recession Proof. It came out the end of February. Those are the exact same 3 reasons I signed with a publisher last August to get a book out about a coming recession. I'm more concerned about a modest U.S. recession, but what Lagarde said last month really highlights the risk of a global recession. 2 caveats with these numbers. Last year's global GDP forecast from the IMF, or the actual reported number they have right now, is 3.1. Their forecast for this year is 3.2. 2 things. 1, it's generally considered acceptable that if global GDP growth is 3% or below, we're technically in a global recession, right? It's not like the way you might have learned about it in economics class. It's 2 consecutive quarters of negative GDP, blah, blah, blah. Nope. If the global economy is growing at 3% or below, global economy is probably in recession. Number 2, the IMF is notoriously rich in their forecasts. In other words, they're always revising them down. And their current forecast is 3.2 for this year. So the odds that we end up below 3%, pretty good. Now, this industry is much more attuned to these things than a lot of other industries. And I'm going to talk about a lot of other data that backs up what y'all are seeing firsthand. But I think it's the data we've just seen, especially about some of the trade data around scrap, really highlights the slowdown in the global economy. Now, the number I'm going to come back to a lot here, as Bill had noted in his welcome letter that I think you all have, the conversation around Ferris begins and ends with China. And right now, the conversation with everything pretty much begins and ends with China. And that 6.5% GDP number that's out there is pure fiction. Let's talk about why. So right now, there is an ongoing Chinese manufacturing recession. Now, the 6.5%, don't worry about that, right? That's just not real. Let's talk about something that is. Every month, there are purchasing manager indices that are collected. What is a purchasing manager index? Well, there's people who work at factories who buy stuff. They turn that stuff into other things that get sold into the market. These are purchasers. And you ask these people every month, are you buying more this month or less? Right? It's a pretty easy question. And you aggregate it over hundreds or thousands of different companies. Now, this is really important because if a purchaser is buying less in a manufacturing setting, that means they're going to be producing less, which means there's less demand on the outbound, right? So, for the Chinese PMI, there's a government one, but there's a private one. The private one is now the Caixin PMI. It's released usually on the first day of a month or the first business day of a month. And for any of these PMIs, I've got three up here. One is for the U.S. economy. That's the ISM. That's the one in blue. The one in green is for the Eurozone, and the one in red is China. For 16 of the past 17 months, the Chinese PMI has shown contraction in manufacturing. Month after month, it's been getting worse. That doesn't just mean there's a recession going on, especially if it drops like it did, say, for April. That means that you might actually have a worsening recession. For the ISM, which is the U.S. number, it bounced in March, as did the Chinese PMI, and it pulled back in April, as did the Chinese PMI. Now, in America, what I hear from a lot of folks is how weak the European economy is and how weak Chinese manufacturing is. But for 9 of the past 10 months, Eurozone manufacturing has been improving at a quicker pace than U.S. manufacturing. And for 5 of those months, Eurozone manufacturing was improving while U.S. manufacturing was contracting. So I have bad news for you if that's your perspective. If you think that everything is great in the U.S., it is not. Manufacturing is actually in a worse position than it is in Europe. And some of that has to do with the central bank cycles, and all of this has to do with what's going on with the dollar and commodity prices.